Given the conflict in Iran, are you altering your investment strategy? What is the plan?
I mean, we've been prepared for both bull markets and then as well as bear markets. I mean, this is what investing's all about, is understanding when to ride and when to tame them. And so right now, the Iran conflict is a big deal. Clearly, I think it's probably going to get settled out a little bit faster than what we've seen, like with the Russia war or what happened in Iraq many years ago. But we're seeing a lot of constraints right now with the oil, and obviously that's why the prices of oil are going through the roof. We were positioned in oil. That's an important commodity right now, something that a part of our thesis has been in play. What I've been ultimately doing, though, is I've been trimming some of my winners, both in AI as well as the Mag 7, and have been raising cash. And so what that's given me the ability to do is to have some dry powder for opportunities like this. But I don't think that we're completely done with the volatility. I think that there's a little bit more ahead, and ultimately, that's what's going to position us very well here for the future, because we're likely in a little bit of a sideways market as opposed to just everything's buy and hold, park and pray, hope everything will be okay, and we can just ride the tide.
Historically, when conflicts break out overseas, how do the markets react? Do we see them rebound quickly, as you've been mentioning?
Yes and no. Certain parts of this are really important. Like, generally speaking, when war occurs, gold and silver ultimately go up. Now we're seeing them actually slipped here today. And so that's maybe a point we should talk about in a little bit, because silver's down almost 10%. But ultimately, they open up new opportunities. And so the world is changing. The way that we are transferring oil around the world is changing. This is why Venezuela was likely a really important idea here just a couple of weeks ago, and getting some of that oil. But drill baby drill economy is going to be producing more here at home, and ultimately I think that we can see, within a short time frame, things more stable, at least on the home front, as it relates to some of those important ways that most people are looking at them.
The price of gold briefly touched 5,400 amid the conflict. How are you approaching gold and other commodities?
Well, gold and silver right now have been going up and up and up in value, which means it takes more U.S. dollars to buy them. So as we continue to default on our debt by about $2 trillion a year, gold and silver are going to continue to rise. Where the real opportunity is that if you look at the sovereign banks, they're able to hold gold right now as a tier one asset. This is very important because the banks are looking for non-collateralized risk, non-third-party risk, and gold is that answer. But here's the reality. Silver is the most undervalued asset as far as commodities go in the world. And here's why. Because if you want NVIDIA chips, if you want data centers, if you want solar panels, you need silver. If you want Lockheed war missiles, you need silver. Silver is the connector of electricity, and this is the opportunity for silver to really break out right now. One underlying factor that most people aren't paying attention to today is the fact that silver, as far as the COMEX is concerned, has been redeemed. Futures contracts generally don't redeem more than 20%. They've been at 50 to 98% redemptions on a month-over-month basis. Literally half of the silver that we had in the COMEX has been dissolved, been taken since October. And so I believe that we're actually months, if not even weeks away from running out of silver in that futures market. So what happens at that point? Silver goes parabolic, goes through the roof. And so I think this is a gift of an opportunity, seeing it down here almost 10% today, especially in the midst of a wartime moment, which again, most times you buy gold and silver when you go to war, and at this moment right now, it's selling off. So I don't think that the price is actually reflective of the real value and the real scarcity in those asset classes here today.
And how are you advising clients given the latest developments overseas?
When we look at the developments overseas, we have to ultimately understand that, our economy is going to continue to go on. NVIDIA is still going to create chips. The AI data centers are going to still happen. But the challenges that we're going to be facing are in the constraints. And so oil prices go up. That could hit the pocketbook of the average American. That could be a really big problem as it relates to GDP. Because if 70% of GDP is the American public and what they have the ability to buy, then we're going to see places like Walmart and Target and others that are going to have greater opportunity, because people are going to spend more thrifty, Dollar General, et cetera, and they're not going to be buying as many luxury items. So we could see some hiccups in what would be considered traditional buying habits, and I think that's really important. But you need to ride bulls and tame bears. I'd be a little bit more cautious right now as we move forward into the future.
All right, David Stryzewski, thank you so much for joining us at the New York Stock Exchange.